Hey traders, welcome to Charts and Coffee. Happy Wednesday, everybody. Hope everyone is doing well. Plan in hand, ready to take on yet another day. And today is starting off with the CPI reaction. And let me bring the chart up here. In fact, let's do this. Let me bring this on over. So today we had the Consumer Price Index. Yes, there is nothing that traders don't like to assign an acronym to or give a nickname to. In this case, we're taking a look at, I will say, the lesser of the two inflation metrics that we're usually dealing with as traders and investors, and that is the Consumer Price Index, CPI, the PCE, the Personal Consumption Expenditures number, is the one that the Federal Reserve uses in their models, but nonetheless, this is an important hot zone. All right, why? And it might seem a little counterintuitive. Let's get to it. One of the things that I sent out to our members in the Sector Secrets Mastery is just a quick heads up that number one, this is an important hot zone. And number two, that the Federal Reserve with this hot zone gets a little bit of a green light to continue on with the rate cuts. Now, we can look at rate cut expectations really easily. Let me show you right now. This is the CME group, and it's the Chicago Mercantile that has the Fed Fund Futures contract. So just like we can trade gold, we can trade Fed Fund Futures, which is lined up with each of the meetings that the Federal Reserve has throughout the year. In fact, you can see their Fed Fund Futures contracts going out into December of 2026. All right, so traders can speculate on what, if any, action will be taken at each one of these scheduled meetings. The notion that we're done with rate cuts is a temporary one. In fact, there's way too much being made of the pause. Yes, the Federal Reserve is pausing. They cut a full 1% last year in a 50 basis point or half point cut, then quarter point increment. And then it does seem that the rest of the cuts that are expected to come are going to be in quarter point increments and won't start until June 18. By June 18, there's almost it's a 55.7% expectation that rates will no longer be at 425 to 450, but rather down a quarter point at 400 to 425. Now, there's further a 22% expectation, which is slightly higher than the expectation for a hold, that we will see 2 quarter point rate cuts by then. So yes, the quarter point cut is about fully baked in. I'll say about, because for me, fully is cumulatively 80%, or singularly, this column here would have to be at 80%. But since the 2 cut columns together are nearly 80, this is about as fully baked in an expectation using Fed Fund Futures as we can get at the moment. So yes, we're going to get more cuts. And if we go out to December of this year, I know, Rag, it's March, right? But what are expectations? Believe me, gang, the Federal Reserve knows that you and me, are looking at this data and that we know what we expect. And it sort of communicates to the Federal Reserve that, one, yeah, we expect rates to go from the current 425 to 450 all the way down likely to 350 to 375, even 325 to 350, which would be 1 full percentage point lower than we are right now by the end of the year. And having the CPI, the jargon is cooler. It's lower than not only forecast, but previous. There's 2 ways you measure what the data is, what was expected and what happened the last time. It was cooler than both. This opens the door to Federal Reserve to continue to cut rates. And it's really important that the Fed be able to cut and then be able to hike, because if the Federal Reserve has to cool something down, they've got to be able to hike without breaking things, which is a whole lot easier when hiking from a lower number. And if the number's too low, the Federal Reserve doesn't have any room to cut rates. Because look, for as much as a few years ago, there was talk about the Federal Reserve going to negative interest rates, that's so bananas and so outside what we should ever be presuming. So the Federal Reserve has to have enough room to hike, but it equally has to have enough room to cut. Therefore, they have to be able to move in certain amount of increments, and expectations are we'll get more cuts. All right. And so as I told my members, the TLDR, the too long didn't read, or too long, give me the Cliff Notes version, right, is stocks like lower rates. Stonks love cheap money. And that's really why, for the most part, we're up right now. Now, this is not the only reason that equities are up. You can see that the trend started moving higher shortly after the Asian session closed, and this crazy candle right there, that is the 830 hot zone. All right, so this is what we've got. It's hard to be bullish for more than a day or two, right? I agree. There's very few bullish structured stocks and sectors. None of the indices are bullish. Most of what we're seeing is a buy calls or sell the rip opportunity. There are a handful of places to be long, and we are long those in the sector secrets mastery. We've rolled out recently out of plays in utilities, plays in staples, plays in Coke. I did take a small loss in Procter & Gamble, did not follow through. I don't add to losers or any such dumb thing. Just take the paper cut and move on. I've got a long position in McDonald's as we start into the morning. However, if we get one of those days that is a rip higher, so a dip is a pullback, a rip is a bounce. If we get a rip day, my list of potential long put symbols outnumbers my long call symbols about 3-1. Absolutely ready to start looking at long puts on a day that we have strength, which would represent a buy calls when we pull back, but buy puts when we rip higher and there's an underlying downtrend. We got a lot of those. So that might be on tap today, which would be great because it was only last week that, based on the tools that I like to use, my visual cues, it was really only last week we started to get the number of candles to the downside, the number of lower lows and lower highs that I like to see in order to expect continuation to the downside. And let me make this super clear. It is far more difficult to trade downtrends and weakness than it is uptrends. And no, I'm not a perma bull, but any conversation about the stock market and the indices and the sectors, any conversation longer term, I mean, not a 1-day expectation, not say a 2-week expectation. I'm talking months to years, right? There is a natural drift to the upside in the equities markets. And let's not forget that. As I like to say, bears are on television, bulls are very quietly, usually anonymously, making money. It is generally better with that longer time horizon to be a bull. And if you checked out the free video that I cut yesterday, I dove right into that topic because there are, not frequently, right? There are certain times where the pullbacks are 10, 20%. And I know after 30 years plus, if I don't build a wish list, right? If I don't have a shopping list of stocks that I want to buy on a longer term time frame, like a weekly, on this pullback, I will regret it in 12 months. So it's a different time horizon, not, Rog, what's going to happen in 12 hours or 12 days, talking fast forward 12 months. And think about having this fluidity, this flexibility to say, hey, I'm a day trader for this time of the day. I'm going to look for swing trades for this time of the day in terms of entries. And let's always keep some time open to looking at that longer term position portfolio. All right. So with that in mind, let's go ahead and jump into the questions. As always, if you have any questions, let me know a few things. What time frame are you looking at, right? Time frame is as important as the symbol. To talk about a symbol without time frame or even a time horizon. Rog, you're looking at the weekly time frame. Is there a buy the dip opportunity in the S&P? Or Rog, if I am looking short term, maybe a 2 to 10 day time horizon, what were those time frames and therefore setups be? So time frame is really important, especially right now. All right, so first up is, what are my thoughts on Amazon? Well, let's see what we've got. Trade what we see, not what we think. And that tells us, and again, there's going to be numerous time frames to look at. I'm going to go to the daily unless otherwise y'all note a different time frame. So Amazon is in a downtrend. It confirmed the downtrend on the 6th of March. It confirmed it, and then it's been continuing since the 7th of March. And so it's in a downtrend. Now, this is where time horizon and time frame are really, really important. if I am a swing trader, so that means overnight, and likely if I'm swing trading, I'm thinking about a time horizon of 2 to 10 days. That's the general window. And then to expiration. For example, we still have Johnson and Johnson. We've hit T1, we've hit T2, and now T3 is likely going to be time, meaning at some point that option's going to expire. They're March 21 expiration options that we alerted out in the Sector Secrets Mastery. Or it'll be a tightened stop. A trailing stop will be tagged, which is designed to protect a certain amount of unrealized profit. So one way or the other, whether that be tightened stop, trailing stop, or time, I'm going to be out. So that's where these are not infinite games we're playing with options. They're depreciating assets. We have to remember that. So it depends on the time horizon. If I'm swing trading, it's short the rip, or it's buy puts into moves higher into resistance. Now, if I'm thinking longer term, if I'm thinking way longer term, Amazon on the weekly could be really interesting if the low at 190.85 can hold, because the weekly might be forming a price pattern, a really old-fashioned, amazing price pattern called a minor low. And that could be something to keep an eye on. The 190.85 level, and I'm sorry, my weekly chart's on this screen over here. The low is 190.85, and ideally follow through happens north of 200.2, and that's what I would keep an eye on there. All right, next up is on the Amazon chart. What is the blue line? The dotted line is a 200. Okay, sure. What's on my chart? Yes. You know, it kind of reminds me of, is it Golf Magazine? The back page, what's in the bag? How many of you read Golf Magazine? I think it's Golf. I don't think it's Golf Digest. I can't remember which one. Maybe it is Golf Digest. But one of these golfing magazines has that last page of what's in the bag. Well, yeah, Rod, what's on the chart? Sure. Let's get into that for a moment. This right here is an anchored volume weighted average price, and it's anchored to, I believe it's Jan 2, whatever the first trading day of the year is. I'm trying to remember if it's Jan 2 or Jan 3. But yes, this is an anchored volume weighted average price. You can see that's where it's anchored to. Bam. All right. And I'll always have that on my screen for the daily time frame for the year. And every year I'll re-anchor it on the first trading day of the year. So that's an anchored, key is anchored, volume weighted average price. All right, the next thing is what's the 200? It's actually not the exponential moving average, but it is a variance of. So yeah, for the most part, if you want to make it a generalization, you can consider it a 200 period exponential. We've tweaked the code on that. So it does turn on and off, as you can see. The dots aren't consistently plotting like a moving average, simple, exponential, whatever would. It does turn on and off based on criteria. The main criteria is it does have a second shorter moving average that if it uncrosses or crosses, it'll turn on and off. So by this segment here where there's no white dots, that means that the shorter moving average is no longer below, in this case, the 200, right? Above or below. So I do use a classic moving average cross to turn this thing on and off, because moving averages are kind of obnoxious. They're always saying something about something. And the truth of the matter is, in a choppy or freshly trending environment, they're not all that good, right? As long as the dots are lit up, I know that there's a lot more importance about whether price is above or below that level, and therefore whether or not I can presume that there's support and resistance at those dots. For case in point, the last dot that lit up pretty much tagged the low on March 4, and then it shut off because the criteria for its validity was gone. So that's what that is. It's a tweaked EMA. That's probably the best way to look at it. All right. Okay, thank you for the question. And by the way, we're technically below it, but it's also turned off. So is it as important, right? It's really not as important any longer. Yeah, red, of course. Next up is how many signals per month can we expect in the Sector Secrets Mastery? So that's a fair question. A lot of folks say, Rog, if I'm gonna invest the time, right? It's the time and money, how many signals could I expect? No one, I'm going to tell you straight up, no one can promise you that, nor should they. So in a trending environment, let's go back 12 months ago. 12 months ago, at this point in the year, mid-March, we had a January that was a triple-digit return month. We had a February that was nearly a triple-digit up month. And then March, which was, I think, about 60 some percent, right? And we were active. I mean, it was very rare to not have 6, 8 swing trades open. We had a straight up uptrend. We had one of the best uptrends that we had seen since likely 2020, 2021, where, just rising tides, strong indices, strong sectors, strong stocks. It's a great time to be active. Right now, we have the opposite of that. So the environment is going to dictate the pace. Now, I will say, just 2 weeks ago, we had 6 open swing trades, 6 for 6. We took our first loss in probably 2 weeks yesterday. Yeah, of course we take losses, right? And that was my Procter & Gamble swing trade. It just didn't hold support. I am never risking max debit. I am never adding to a loser. Losers add to losers. Gang, I promise you, if you continue to add to losers, every now and then, even if you take one loss in 10 trades, it will likely undo most of the gains of the previous wins. That's why most traders' P&Ls look like chutes and ladders, right? That's why they don't have consistent account growth. That's why they stay trading small accounts. They don't know how to position size and manage risk. That's the game, gang. It's managing risk, right? So I took a haircut, if you will, on Procter & Gamble. So it depends on the structure. Now, if the downtrends can persist, then yeah, we'll probably have more signals, long puts, that'll set up more trades. Right now, I've got 2 open swings as we're 12 days into March, and I'm less interested in the number of trades. A lot of traders are interested in activity. I don't get paid for staying busy. I get paid for buying low and selling high. And if that means it's a Johnson & Johnson trade, which at this point is well over, I believe, a 200% return on initial premium paid, great. That's all I care about. Quantity is not the game. Quality is. But really, the quantity is dictated by underlying market behavior, right? I think also in the same vein of that, I'm never looking for a target gain for a month. Also, unbelievably bad habit that a lot of traders develop. Oh, I want to make this many trades per week and I want to make this much money per month. It doesn't work that way. In fact, if you would have told me last January, if I had a target, I'd be happy with 25%. I never do this, but let's say I did. I would have been wrong by a factor of 4 because we ended up doing, I think, 108% in January. Everything was straight up. It was hard to lose, and it was hard not to get monster follow through. So that's why I say trading is like surfing. I can't dictate the waves that are coming in. That's the ocean, right? The market is the ocean, but I am a surfer, right? So I can paddle out to where I need to be to best take advantage of it. And I think once we start thinking we can control the ocean, we're in big trouble. And that's where I say the pace, the number of trades, the follow through is not dictated by the strategy or by the indicator. And I love my indicators, but I'm still a surfer on the ocean, right? I'm waiting for my set, got to put myself in the right spot, and I've got to have the skill to be able to surf the wave to the shore. All right, next up is take a look at the anchored VWAP on the QQQ. So my anchored VWAP on the NASDAQ would be on the NQ futures. And then I'll anchor it to the first trading day of the year. And then if I'm not doing that, right, I think one of the most dangerous things is to start to have too much variance in the anchors. Because if I'm not anchoring there, John, and thank you for the question, the next place I'm going to anchor is back to 2020. And that's March 23rd. And I'll have an anchored VWAP there. And we're still hovering over the first standard deviation of that. So I think having a fixed anchored volume weighted average approach. So fixed meaning what are the reasons that we would anchor at a certain spot? So I wouldn't have one going back to January of 2024. If it's not the first trading day of this year, then I'll go to the weekly chart and I'll anchor and I'll continue to focus on the anchor of 2020. In the coming days, gang, I'll talk about some of these anchored VWAPs that I use and how powerful they are if you can use a fixed approach. But right now, yeah, we're still actually still hovering above the first standard deviation, which is historically a really good spot to be. I'm not bearish at all. All right, gang, be good to each other. I'll see you tomorrow. Same time, same station.